Corporate Finance Presentation, Capital Budgeting Decision Overview. Get ready, it's time to take your chance with Corporate Finance. Capital Budgeting, planning for projects and future cash flows extending more than 1 year. So we're thinking about our capital allocation. We're typically thinking about the capital allocation often in the format of us putting down a large amount of money up front in order to invest in something that we expect to have a future cash inflow in. The idea being that these are longer-term types of projects. Because they're longer-term types of projects, we want to take into consideration the time value of money, and we also have a lot more uncertainty as we think out into the future. So these types of decisions we want to make separate from normal like day-to-day type decisions. So when we're doing our decision-making processes, you can kind of break them out from a managerial type of standpoint to the type of decisions that are the day-to-day type of decisions and the type of decisions that are going to be long-term type of decisions that could have an impact, substantial impact into the future. Those long-term decisions are often areas where us as human beings have more problems to think about all the risks and whatnot that will be involved in the future, and therefore a formal process for that long-term decision-making process is generally a good idea. So added planning is needed because of the long-term impact. So we have a lot of uncertainty out into the future. So therefore, we want to make sure that we sit down and think about where we want to put our capital allocation, given the fact that these are the types of decisions that once made are much more difficult to reverse or change. Many things that are the day-to-day type decisions, you'll note, we can use kind of a trial and error type of method. We can kind of tinker with things. We can basically make decisions, we can see what happens, we can alter our decisions, and so on. Other types of decisions, that type of tinkering method doesn't really work that well because you don't really have a lot of chances to make the big decisions. If the big decisions include the big capital outlay type of decisions, those big capital outlays could include things like, do we want to start a new project? Do we want to buy a big new piece of equipment? Do we want to be replacing the current piece of equipment with another piece of equipment? Do we want to invest in a large amount of inventory at this point in time? Those kind of decision-making processes are things, if they require a large capital investment and we have expected inflows multiple years into the future, are the ones that we want to spend more time with before we make them. Often requires input from multiple departments. So as we make these long-term decisions, if we're thinking about putting a substantial amount of money down on a project or on equipment or something like that, in order for us to make that decision, we're going to need a lot of inputs to know exactly what the impacts will be. The bottom line decision that we will make will typically be geared on time value of money, cash flow type of decisions, the return that we're going to be getting. We will be applying then generally time value kind of principles, net present value and internal rate of return, which we'll talk about in the future. But in order to get to those assumptions, we've got to talk to different people, different departments to see what those assumptions will be so that we can then apply the time value of money principles. So it includes uncertainty about annual cash outflows and inflows. So when making these types of decisions, we have to somehow we can think about what the outflow will be, which typically it might be a little bit easier, but that would even be more complex than you would think, even though that would be what we would expect to happen at time period 0, basically now, if we were to make the decision, right? And then in the future, we're thinking about inflows. And if we're talking about inflows that will be more than a year out, then that's going to be a lot more difficult to think about because there could be changes and we don't know exactly what the inflows will be. We have to estimate those into the future, and we have to do it on generally a yearly basis or a period by period, a standard period basis, which is typically yearly, so that we can then apply our principles of time value of money to them to then help us make the decisions out into the future, taking into consideration time value of money. Life of the assets is also going to be a concern. If we're putting a large amount of money into some kind of capital asset, which is often the case, something like equipment, building projects that are going to include buildings and equipment and so on, then what's going to be the life of that asset? How long is it going to help us to generate revenue? Remember, our goal here is always, when we're thinking about these types of decisions from a business standpoint, is whether or not we're going to have a return on it. What's going to be the bottom line in terms of revenue? When we think of revenue, in this case, we're usually thinking about cash flow revenue for these types of decisions so that we can use our present value tools for them. So when we think about purchasing something like an asset or equipment or putting money into projects or inventory, then we have those assets so that, of course, we can generate future returns on them. So when we think about those assets investments, we're thinking about what types of returns or what kind of savings will be applicable in the future. So then we also have the interest rate that's going to be applied. So what kind of rates will be there today versus, of course, the future. Is basically the economic landscape going to be the same? We have to figure out when we apply our methods of time value of money, which will be the net present value and the internal rate of return. We're going to be assuming a rate of return and using a discount rate within that calculation. Economic factors, are there going to be changes in economic factors in the future? That, of course, is a huge unknown. All we can do is basically guess what's going to be happening in the future. Will people still be demanding what it is that we're trying to make here in the future? Because obviously we are taking a risk trying to enter into the market and provide something that hopefully people want in the future. If demand changes, then that will be a problem. Is the tax environment going to be the same? Is the regulatory environment going to be the same? Are there going to be changes in those aspects? If there are, those of course can have significant impacts on our projections as well. And we don't know what's going to happen in the future. So businesses typically like to have some idea, some stability, so they can then make these long-term decisions. So changes in technology. Obviously, things are changing quickly in terms of technology as well. Another factor that, especially in particular types of industries, that if we're making a long-term investment and we're in an industry where technology changes quickly, then it could be that our investment becomes obsolete before we know or we're expecting it to. So the process will typically look something like this. We're going to look for the potential investment opportunities. So as a business, when we have our capital, we're generating our capital. We're thinking, where do we want to put that in order to get a return? We're going to look for opportunities that we think we can invest in and get a good rate of return. Then we're going to collect our data on those investments. We're going to start to analyze them and think about them in terms of the data for those opportunities. Then we're going to assess and make a decision. We're going to decide which ones to put our money in. And we'll talk more about this decision-making process. That's going to be part of what we'll get into. How are we going to judge these different projects or these different opportunities? How can we compare one to the other? Should we be accepting a bunch of them? Or what if we can only accept one or two? And then once we make the decision, we'll review the decision and make appropriate adjustments and improvements as we go. Now, obviously, this last piece, again, this is like any kind of decision, right? We basically think about what we can do, we collect the data on it, and then we assess the data, make the decision, and then we'll improve on it as we go in the future. As more information happens, as we roll into the future, we will make the improvements that we can. But again, unlike other decisions, because this is a large capital investment decision, we do want to make sure that we do these first steps a lot more thoroughly. And note that if you're talking about managerial decisions from a day-to-day standpoint, then there are some things in a company setting or a management setting where you can use trial and error, where it's appropriate to basically say, we'll throw this out there and see where the cards fall where they may and whatnot, and then we'll assess it and we'll do it again. But again, these long-term decisions, you can't do that so much. So although we have the same kind of cycle for decision-making process, we probably want to do a lot more on the analytical side of the decision-making process, whereas if some other decisions, you might be better off going kind of with your gut and then making adjustments as you go. You might still have your gut here to think about what's going to happen in certain factors, but you want to have both the analytics before you make the decision, where you are more likely to make the right decision up front, because these are types of decisions where the saying goes, these are the kind of decisions where you kind of want to measure twice and cut once. If you're measuring wood for a door frame or something like that, you don't want to cut it too short or something, measure twice, cut once. These are more of those types of decisions, these longer term ones. So in a flow chart kind of thing, you might have an idea, then you're going to collect data on it. When you're doing the data collection, you want to make sure that we're talking to the relevant people that are going to be impacted by this long-term decision. That could include the accounting department, finance, it could include engineering, so that we get the relevant data so that we can make our assessments that will be happening in terms of the future cash flows. And then we're going to create the probabilities of what's going to happen. Once again, we're in the future. We don't really know what's going to happen in the future. So one way we can kind of think about future things is to assign probabilities and try to use kind of a statistical type of approach to make our decision-making process. Assess and make a decision, and then we're going to look at the outcome, and then we'll reevaluate and adjust probabilities as needed, and we'll have that circular fashion here to the extent that we can as we move into the future. So cash flow is generally used instead of the accrual accounting. So note, when we're making these decisions, if you look at like the accounting process, generally accepted accounting principles or normal accounting, where we usually use accrual accounting there, which makes perfect sense when you're trying to measure the performance from period to period. Accrual accounting makes sense. But when you're thinking about a planning long-term plan into the future, then we're typically want to do that with cash flow type of accounting, because we're able to utilize our tools a little bit better, meaning if I'm expecting a large cash flow to go out up front, and then I want to assess the inflows that are going to be happening in terms of cash in the future, and then we want to use our time value of money methods, which will include the net present value and the internal rate of returns, generally the main two methods, to basically discount our cash flows, and that'll allow us to kind of compare projects. To do that accurately, we're going to need to be basically on a cash basis method. Now, we're still going to have to deal with some kind of issues with accrual accounting, especially things like depreciation on a tax basis, because on a tax basis, things like depreciation, which is an accrual concept, will have an impact. We'll talk more about that later. Well, they'll have an impact on the cash side of things because the taxes have a cash impact. So, for example, if we had the data for something like this, we had the earnings before depreciation and taxes, and then we invested in something that had depreciation, for example, we're saying $49,000 of depreciation and the tax rate is 35%, then we want to see what the tax impact is related to the depreciation. Because in that type of scenario, we may have put the money down for the fixed asset up front, but for taxes, we don't get the deduction for taxes up front when we put the money down. And therefore, we have to allocate the depreciation over the useful life of the equipment to see when we get the benefit. Now, of course, the tax code is another thing that changes from year to year. That's another uncertainty that we don't know, but we can make estimates based on that. So it would look something like this if we had the earnings before taxes. Here, we then take into consideration the depreciation, $49,000, earnings before taxes. This was before taxes and depreciation. Earning before taxes, $62,000. 62,000 times 35% would be 21,700. The 62,000 minus the 21,700 would give the 40,300. And the only reason we took out this depreciation in this example was so that we can then calculate the taxes. The taxes are going to complicate things a lot. So the depreciation is an accrual concept. We would really eliminate it typically when we're thinking about our cash basis future projections. But for the tax purposes, we have to think about tax depreciation so that we can see the tax impact related to it. And then we're going to pull the depreciation back out to get to the cash flow. Now, if that doesn't make a lot of sense right now, that's okay. We'll go through many practice problems on this, and the best way to get a good handle on these, like many of these finance kind of concepts, is to do the practice problems. We will have a lot of them. So don't worry about that. If you don't fully understand that, work the practice problems over and over and over and over again. So tools for making investment decisions. We have the payback period, we have the net present value, NPV, and the internal rate of return, the IRR, that we're going to go through here. Now, of these three, the payback period is the least helpful, but it's a good intro into the concepts, and it's a good kind of precursor type of calculation. The primary two calculations that will be involved are going to be the net present value, the NPV, and the internal rate of return. Why? Because these two take into consideration time value of money. So the idea then being, we're thinking about a large capital investment. Usually we have money going out up front, a substantial amount of money, in order to receive future cash flows in the future. We're going to be accounting for it on a cash flow basis when we do our projections, so that we can break out our cash flows on a year-by-year basis generally, and then apply our time value of money principles using these two methods, the net present value method and the internal rate of return method, so that we can then have something that will be comparable, decide whether we want to invest in the project, decide which projects would be better, which would have a higher rate of return. The payback period does not include the time value of money, but it's a nice quick calculation that can give you an idea of when you're going to get the money back. And it's a good introduction into the time value of money types of principles. So although the payback period is a good calculation worth doing, it's only one calculation amongst others. Because remember, we're trying to predict out into the future. So we might have multiple different projections. We might run multiple different scenarios. And we might want to look at it in multiple different ways. We might want to calculate all of these three things on it and see what we get as we compare different projects to them, so that we can get different angles to look into the future at. We can try to get different angles to kind of peer into the future to make our best decision. However, for book problems, note that the payback period is often used to contrast the limitations of something that doesn't use the time value money with the calculations that do. So when you see book problems comparing payback period and net present value and internal rate of return, they're oftentimes going to be accentuating the problems with the payback period. It doesn't mean the payback period is a bad calculation. It just means that there's limitations that you have to keep in mind. And of course, the book problem is going to point out those limitations, both to let you know about them for the payback period, but also to accentuate the good things about the net present value calculations. The main good thing about these calculations is the fact that they have the time value of money calculation included within them.